This is The Bottom Line. The Bottom Line on 938 Live.
Now, the U.S. Federal Reserve's Federal Open Market Committee, or FOMC, concluded a two-day meeting on its monetary policy. How will their policy decisions affect markets here in Asia? For more on the economic ramifications this week, we have on the line with us Daniel Martin. He's Asia Economist at Capital Economics. Now, Dan, the Fed continued to cut its monthly bond buying program further by another $10 billion as expected. Were markets expecting more from the central bank, though?
No, I think that's just about as expected, and I think that they're expecting the same until October, so another $10 billion tapered every month. The bigger interest at this meeting was whether there are any signals on when rate hikes might come. The markets seem to have been reassured by them saying that there's some slack in the labour market, but we think some of their comments actually suggest that rate hikes might come sooner than expected. They said there's less risk of inflation being below 2%, and that unemployment is no longer elevated. So maybe a rate hike by March, and until then, that's what markets are going to be looking at.
Right. Now, the U.S. economy rebounded in the second quarter at a 4% annual rate. Will this positive momentum continue for the rest of the year?
I don't think the Q2 momentum is going to be sustained. 4% growth is really fast, and it reflected a bounce back from bad weather in the first quarter. But the prospects are reasonably good. We expect strong income growth to be a big feature of the second half of the year. And for the year as a whole, we expect growth of around 2%, so pretty decent, not much of a change from last year.
How will the Ukraine crisis and Russian sanctions from Western countries affect the economies in Asia?
I don't think they have too much exposure, to be honest. The sanctions are going to hit Russia specifically. The Ukraine is obviously suffering from all this as well. But outside of Russia and the Ukraine, I don't see much of an effect. Even Europe doesn't export much to Russia, and it isn't as reliant as many think on energy imports from Russia. And Asia's even less exposed by that, so I don't expect much of a market impact over here.
Now, traders are also keeping a watchful eye on the U.S. July jobs report due tomorrow. Which direction do you think the equity markets are likely to move?
Well, we're looking at the job report to show a gain of around 225,000, which is pretty much what the markets are expecting. So we don't think there'll be any big moves in the market afterwards. If anything, though, there's probably a slight upside risk, which would have a positive impact on the markets.
Now, finally, what's your outlook on the U.S. dollar against Asian currencies, and in particular the Sing dollar?
A lot's going to depend on how markets react to Fed tightening over the next year. Now, we think most of the impact has already been factored in by markets. They had their taper tantrum last year. So we think when the Fed does eventually raise rates, it won't be the big story that some are expecting. And now if you look at Asian currencies from just a fundamentals point of view, current account surpluses are quite large. They're still going to have a positive growth differential with most of the West. So that should mean that Asian currencies do quite well. So we're expecting most currencies, including the Singapore dollar, to appreciate against the US dollar next year.
All right. Well, thank you very much, Daniel Martin, Asia Economist at Capital Economics, on The Bottom Line.